Happy Valentine's Day. It is February 14th, 2026. And while half the world is scrambling for restaurant reservations or, last-minute chocolates, we're going to focus on a different kind of relationship.
So let me guess. One that's arguably more complicated.
Definitely more complicated. Certainly more expensive. And, according to our data today, one that is finally starting to work again.
You must be talking about let's call it the romance between commercial real estate buyers and sellers.
Because for the last couple of years, that relationship has been, well, let's just say frosty.
Frosty is a polite word for it.
Maybe even a little toxic.
I'd go with dysfunctional. I mean, you had sellers living in the past, buyers absolutely terrified of the future. It wasn't a great match.
Fair point. But today we're doing a deep dive into an insider market update from Eureka Business Group and Joseph Goslan, and it suggests maybe the therapy is finally working. The headline is that the market is gaining momentum here in Q1 of 2026. But what really caught my eye wasn't just that deals are happening, it's how they're happening.
Right. It's the terms of engagement. The ground rules have completely changed.
Exactly. So our mission today is to unpack this thaw. We're going to look at three sort of buckets of opportunities this update highlighted. You've got the safe yield plays,
The money printers,
the heavy lift value add projects for the brave souls out there, and then some really unique outliers. I mean, we're talking sealed bids, historic zoning, stuff that doesn't fit in a neat little box.
And the common thread, the thing that connects all of them, is really the price of admission. The data shows a really clear shift in what sellers are finally willing to accept.
That is exactly where I want to start. The notes mention sellers were finally coming to terms with higher cap rates. Now, to someone new to this, coming to terms sounds like a very nice way of saying giving up.
Well, in negotiation, it kind of is. You have to remember the standoff we've been in. Sellers were just clinging to 2021 pricing, basically pretending interest rates hadn't shot up.
And buyers just couldn't make the math work.
The math was impossible. The cost of borrowing was too high. So this thaw really just means that the sellers have blinked. They realize that to sell an asset in 2026, you have to offer a yield that actually competes with the cost of money.
And we are seeing that in the actual numbers. So let's look at this first bucket, the yield chasers. These are the assets, say, under $2 million.
Right, mailbox money territory.
This is where the individual investor lives. And there's a listing in here in Killeen, Texas, that it really made me do a double take.
The Jack in the Box?
The Jack in the Box. It's what, 2,464 square feet? But look at that cap rate, 7.77%.
That is a big number for a national burger chain, a very big number.
It's a huge number. I mean, a few years ago, a brand like that would trade for what, 5%? Maybe 5.5%?
Oh, easily. 5.5%. You were paying a huge premium just for that safety. Seeing it near 8%. That tells you everything about how the risk premium has shifted. The market is demanding a higher return.
But is it actually risky? Because the listing uses the magic words, absolute NNN, triple net.
No, and that's the irony, right? Absolute NNN is the golden ticket. It's what every passive investor wants. It means zero. And I mean zero. Landlord responsibility.
So you don't fix the roof.
You don't fix the roof, you don't pay the insurance, you don't even worry about potholes in the parking lot. The tenant Jack in the Box pays for all of it. You cash the check.
So I get a corporate-backed 7.77% return, and I never have to unclog a toilet.
That's the deal. And it's got a nearly 20-year operating history in that same spot. So this isn't some new concept testing the waters. It's a staple. The fact that you can buy that kind of stability at that yield, it's the clearest signal yet that it is a buyer's market.
It's basically a bond wrapped in a hamburger wrapper.
That's a great way to put it.
And it's not just fast food. There's another one in this yield chaser bucket, Corsicana, Texas. It's a retail spot, about 9,000 square feet. Cap rate is almost identical, 7.75%.
And that just reinforces that this isn't a fluke. The market has repriced safety into the high sevens. But that Corsicana deal has a slightly different flavor. It specifically mentions a corporate guarantee and annual rent increases.
I do love the sound of annual rent increases. It feels proactive.
It's absolutely necessary. I mean, in an inflationary world, a flat lease is a losing lease. If your own costs are going up but your rent check is the same for 10 years, you're actually losing money in real terms. Those annual bumps, they're your hedge. They protect your purchasing power.
Right. And that building sees 15,000 cars a day. So whether it's burgers or retail, the takeaway for you, the listener, seems to be, if you have cash, you don't have to settle anymore. You can demand quality and a high yield.
Precisely. You're not compromising on the quality of the asset just to get a decent return. That is a luxury that buyers have not had in a very, very long time. It used to be you had to buy something ugly or risky to get an 8% return. Now you can get a national brand on a main street.
Okay, but let's say you're not looking for a safe 7%. Let's say you want to get your hands dirty.
Yeah.
You want to force some appreciation.
Mm-hmm.
Now we move into bucket number 2, the value hunters.
This is where the work and the real opportunity begins.
And probably the headaches, too. There's a listing in McKinney, Texas. It's a gym right now, but it's technically medical office space.
Yeah.
2 combined units. And the listing is almost screaming, selling well below county assessed value.
That's always a red flag and the green flag at the same time.
Right. I mean, usually if you're selling below the tax assessment, something's seriously wrong. Maybe the roof is about to collapse.
Yeah.
But the part that really got my attention was the financing. It says owner financing available. Why are we seeing that pop up now?
Because traditional banks are still being really difficult. Even with this thaw, lending standards are tight. Loan-to-value ratios are, let's say, conservative. So when a seller offers owner financing, they are basically becoming the bank for you.
No, I don't have to go beg a loan officer for an approval.
You get to bypass a ton of that red tape. It usually means a faster close, more flexible terms. But more than anything, it signals motivation. A seller who's willing to carry the note is a seller who needs to sell. They are removing the single biggest barrier for you, the bank, just to get the deal done.
So you're getting a discount on the price and easier terms to get in. That's a pretty powerful combo.
It is. It lets you step in, stabilize the asset with their money, and then you can refinance with a traditional bank later on once the numbers look better. You're using the seller's balance sheet to get into the game.
Okay, speaking of stabilizing, let's look at this multifamily deal. Lakewood in Dallas. 12 units. It says 100% occupied. Now explain this to me. The listing also claims there's value add potential. If the building is full, where's the value add? Are we building a 13th unit on the roof or something?
Not likely, no. In the multifamily world, 100% occupied is very often code for your rents are too low.
Ah, so you're the cheapest game in town, so nobody ever leaves.
Exactly. If you have zero vacancy in a hot area like Lakewood, you are leaving money on the table. Your tenants are probably paying 2023 or 2024 rates. So the value add here isn't necessarily knocking down walls or putting in granite, though it might include that. It's operational. It's about management.
So it's about being the bad guy who raises the rent.
Or the business person who brings the asset up to market standards. You buy it, you realize the current owner is undermanaging it. Maybe they're tired, maybe they just don't like confrontation. And you spot that gap between the current rent and the market rent. That gap, that's your profit margin.
You're literally buying the loss to lease.
Correct. And in a neighborhood like Lakewood, which is so desirable, that spread can be huge. You just turn over the units as leases expire, maybe do some light renovations, and suddenly the building is worth 30 or 40% more based on that new net operating income.
Okay, let's shift gears. We've done the safe stuff. We've done the fixer-uppers. Now I want to look at the flight to quality. This is the $2 to $10 million range. These assets they feel shinier.
They do. This is approaching institutional grade.
The one that stood out to me is in Flower Mound, a 17,000 square foot retail center, brand new, built in 2022. But the stat that just jumped off the page was the household income, average income in a 1-mile radius, $177,000.
That is an incredible demographic profile. Just incredible.
But why does that specific number matter so much? I mean, we know rich people are good for business, but does it really change the math for an investor?
Oh, absolutely. Disposable income is the lifeblood of retail. Retail follows the money. When you have a trade area with an average income pushing 180 grand, your tenants are just safer. Even if the broader economy takes a dip, the people in Flower Mound are probably still buying their lattes and going to the dentist. You are literally buying a buffer against a recession.
So you pay more for the building, but you sleep a lot better at night.
That's it exactly. You're not buying this for a 10% cash-on-cash return. You're buying it for wealth preservation. It's what we call a core asset. It's safe, it's new, and it's in a high-growth area.
Okay, on the complete flip side of a massive retail center, there's this tiny listing in Plano, 756 square feet, a medical office condo near Willow Bend. This fascinates me. Why would anyone buy something that small?
Because of who the user is. Think about a psychiatrist, a high-end consultant, maybe a plastic surgeon who only does consultations there. They don't need a giant space. They need a prestigious address.
And Willow Bend is definitely prestigious.
It is. But here's the key. There is almost no inventory that small. Developers don't build 700 square foot buildings, they build 10,000 square foot buildings. So if you're a solo practitioner and you want to own your space instead of renting, you have almost zero options.
So scarcity drives the value.
Completely. It's a micro opportunity, but for that very specific buyer, it is a unicorn. It's an equity play. Why pay rent for 30 years when you can own the box?
Okay, staying on medical, let's talk about Schertz, Texas. There's a listing for an ABA therapy center, and the listing uses that phrase we always hear, recession resistant. Is that just marketing, or is there something really to that?
In this case, it's very real. ABA, that's Applied Behavior Analysis, it's the primary medical treatment for autism. This is a medical necessity for these families.
It's not a luxury purchase.
Yeah.
You don't cut it from the budget.
Never. If the stock market crashes, you might cancel Netflix, you might stop going out to eat, but you do not stop your child's therapy. And on top of that, it's almost always covered by insurance. So the revenue stream for that tenant is backed by major insurers, not just by consumer spending.
And the tenant has 26 locations. This isn't mom and pop shop.
Exactly. So when you see a 7.35% cap rate on an asset like that, you have to weigh it differently than, say, a 7.7% on a burger joint. The stickiness of a medical tenant like this is incredibly high.
Right.
They invest a fortune in the build-out with treatment rooms and sensory areas. They don't just pack up and leave when the lease is up.
It's a truly defensive play.
100%. If you think the economy is going to be shaky for the next few years, this is the kind of asset you want to own.
Okay, we have to get to my favorite part of this deep dive, the wild cards. These are the deals that just don't fit in a neat box. The ones that made me stop and go, wait, how does that even work?
The outliers are often where the outsized returns live, but also where the outsized headaches can live.
So let's start with Cedar Hill, downtown. There's a vacant retail building. Now, usually vacant would scare people off immediately, but the listing is leaning really hard on historic downtown zoning.
That's a pure scarcity play. They aren't making any more historic downtowns. You can build a new strip mall out on the highway anytime, but you can't manufacture a 1920s Main Street vibe.
So you're betting on the revitalization of the entire district.
You are. It is absolutely speculative. You have zero income on day one. But if the city is pouring money into that area, and if that district becomes the cool place to be, the place with the craft brewery and the art galleries, that property value could double or triple. You're buying potential, not cash flow.
High risk, high reward. But still, in Cedar Hill, there's a land deal that just fascinated me. Almost 38 acres of residential land. But you can't just call up and make an offer. It's a sealed bid opportunity from the school district.
The sealed bid. This is more about psychology than it is about real estate.
So walk me through this. Why does a public entity like a school district do a sealed bid? Are they trying to be mysterious?
No, not at all. It's about public accountability. They have to prove to the taxpayers that they got the best possible price in a fair and open process. They can't just, do a handshake deal with a friendly developer. So they set a hard deadline, and everyone submits their single best offer in a sealed envelope.
It's like blind poker.
It is, and that terrifies a lot of buyers. Most investors want to negotiate. They want to offer $1 million and hear back, we want 1.2. In a sealed bid, you get one shot. You have no idea if you're bidding against 10 other people or if you're the only one.
And that fear actually reduces the buyer pool.
Drastically. A lot of developers won't even bother because they hate the uncertainty. And that is where the opportunity is. If you do your homework and you have a very clear idea of what that land is worth to you, you might put in a bid and find out you were the only one in the room. You can get assets way below market value just because the format scared everyone else away.
I love that. You're using the process itself to get a better deal?
Exactly. It's an arbitrage that favors the diligent.
One more wild card. Roanoke, Texas. Industrial flex space. The listing highlights 3 little words. Outside city limits. Now, to me, that just sounds like it's in the middle of nowhere. Why is that a selling point?
Freedom. It's all about freedom. If you're inside the city limits, you have zoning, you have sign ordinances, you have code enforcement, you have noise restrictions.
And if I'm running a machine shop or storing heavy equipment,
You don't want any of those headaches. You don't want someone telling you that you can't park your trucks in the front. Being in the ETJ, the extraterritorial jurisdiction usually means lower taxes and way looser regulations.
so it's a Wild West, basically.
For an industrial user, yes. For a welding shop, a big landscaping company, a small distribution hub, that outside city limit status is worth a premium. It's operational liberty. You can just run your business without constantly looking over your shoulder.
So we've covered the whole spectrum, but there's one last concept I want to touch on, the ground lease. There's a Wells Fargo in Fort Worth on a Walmart outparcel, prime location. But with the ground lease, you're not buying the building, you're just buying the dirt.
You are buying the dirt, and you are leasing that dirt to Wells Fargo for a very, very long time, usually 50 to 99 years. They build their own building, they own their building.
So if the roof leaks,
It's not your problem. You don't own a roof.
if the air conditioning dies.
Not your problem. You are the landlord of the soil. It is arguably the safest form of real estate investment because the tenant has a massive incentive to pay you. If they ever default on their ground rent, you typically get to keep their multi-million-dollar building.
So it really is just like a bond.
It acts exactly like a bond. Very low risk, and because of that, a lower yield. But it's a generational wealth play. You buy it for your grandkids, not for next month's grocery money. It's where you park capital that you simply cannot afford to lose.
So let's bring this all back to where we started, the idea of a thaw.
Mm-hmm.
It's February 2026. What does this whole menu of options, from 8% burgers to historic gambles, tell you about the year ahead?
It tells me the paralysis is over. I mean, for 2 years, we had a staring contest. Buyers waiting for prices to crash, sellers waiting for interest rates to fall. That's done. We finally have clarity. Sellers have accepted the new reality of cap rates, and buyers are seeing these 7.7% returns and saying, okay, the math finally works.
The gears are actually turning again.
They are, and the variety is the healthiest part. A functioning market needs options for the safety seeker, the value-add person, and the speculator. We finally have inventory in all three of those buckets again. It's not just a wasteland of overpriced, stale listings anymore.
Which brings us to the big question for you, the listener. If you're sitting on cash, the window is clearly open. But I do want to leave you with one final thought.
Go for it.
We are seeing cap rates near 8% for strong, stable assets like that Jack in the Box. That is historically very high. This report calls this gaining momentum. But my question is, are we at the peak of buyer power right now?
That is the multi-million-dollar question, isn't it?
I mean, if interest rates tick down later this year, or if the economy really accelerates, those cap rates are going to compress again. Prices will go up, yields will go down. So are these 7.7% deals going to look like the bargain of a lifetime in 12 months?
It's very possible. If rates drop, that asset you bought of a 7.7 cap suddenly becomes worth a lot more to the next buyer who can borrow cheaper money. You get the great cash flow now and the appreciation later. You could win twice.
So the thaw might actually just be the precursor to a scorcher.
It wouldn't be the first time. Real estate moves in cycles, and we might just be standing at the bottom of the next big upswing.
Well, there you have it. Whether you're looking for a recession-resistant therapy center or a blind bid land deal, the 2026 market is definitely awake.
And it's offering plenty of opportunities to make or lose a lot of money.
If you want to dig deeper into these specific numbers, you should check out the Eureka Business Group updates. But more importantly, just look around your own backyard. Drive past those for sale signs. Are they gathering dust or are they disappearing? That's your real-time data right there.
The best market intel is always local. Always.
Thanks for joining us on The Deep Dive. Happy hunting out there, and we will catch you on the next one.